Hello there, and you're watching Dukascopy TV today. I'm Doireann Mc Dermott, and right now we're going to have a look at Asia. Well, Moody's said this week China will grow in and around 7.5 to 8.5%, and it believes China is recovering quite well after avoiding a hard landing. Right now I'm joined by Laurent Godin, and he is from Pictet Cie. So welcome today.
Thank you for welcoming me. So when we look at the China economy, since 2009, we have a steadily sliding rate of GDP growth. And that shows how tired the economic model based on strong investment has become. And then if you look at 2012, all the economic indicators released until autumn, they were all disappointing. At a point that the market fears was for a crash in the economy. Of course, there was no crash. There is a lot of drama on China, but there was no crash. It was just a normalization of the growth trajectory in China. And what we had in the fourth quarter was a rebound in the activity. Basically, we had the government that engineered a mini stimulus, and that was the classical recipe of a rebound in the economic activity based on fostering construction and lending. And it's easy to engineer in China for the government because they control all the levers of investment. The problem though in China is that we saw since 2010 a sharp increase in the leverage of the economy. If you look at the ratio of debt to GDP, it moved from 160% to 190% within 2 years. And that only helped to stabilize the economy. So what we have is just a normalization of the GDP growth in China. We are looking in terms of new yardstick for the GDP growth in China for the years to come. We're looking at numbers between 6.5 to 7%. Just for 2012, we can isolate two main reasons for the slowdown in the economy. You have an external shock linked to the weakness in exports on the back of sluggish world economic growth, and then you have domestic factors. That was the slowdown in the construction activity in China. But the slowdown is also built in the long-term goal of the government to rebalance the economy from an investment-led economy to a consumer-driven economy. If you look at the ratio of investment to GDP in China, it's pretty unsustainable. It stands at 46%. If you look at what was the ratio at the peak for Japan in 1973, it was at 36%. In Korea in 1991, it reached 38%. So in China, you have a massive investment level, which is unsustainable.
And Laurent, let's have a look at structural reform. Do you think China will be successful in making more progress?
Basically, we see two main axes for the reform. The first one is to implement a social welfare, and the second one is to increase the liberalization in the economy. More short-term for 2013, in terms of policy change, we see three main areas. The first one is, again, fostering the welfare state, but that will be initial stages. We are going to see as well price reform in energy, utilities, and transportation. And the third reform, which is one of the most important, is financial market reforms. And those three reforms that are going to be implemented this year and the years to come are going to lead to all range of changes for the economy. We're going to have higher energy prices and higher environmental costs, which is going to be detrimental for the heavy industries, for the energy-intensive industries. We're going to see as well more social spending, which is going to be positive for the sectors like insurance, leisure, consumer, education, hotels. And we're going to see as well an increase in the labor cost. So this is going to add pressure to the labor-intensive sectors. So it's going to be bad for the labor-intensive sectors. And of course, as for the financial reform, this is going to decrease the dominance of the banks in the Chinese economy.
Now, Laurent, let's turn our eyes to Japan. Many expect export recovery along with a weaker yen and, of course, improving global demand will put Japan back on the path of recovery. Now, do you think, they will actually do quite better this year? And, of course, do you think Shinzo Abe will help Japan be on this path to recovery?
Well, if you look at the region, most of the countries in Asia, they started to see GDP growth to improve sequentially in the fourth quarter 2012. But the exception was Japan, where actually the GDP contracted. However, the last indicators show that the economy in Japan has started to rebound a little bit. What happened is that the yen depreciated against most of Asian currencies by 20% since November 2012. Year to date, the yen depreciated 10% against the US dollars. As a rule of thumb, any 10% fall in the yen to the US dollars could boost the GDP by 0.4%. And if you add to this the extra boost by the fiscal package announced by the government, that could add an extra 0.3%. So total, you reach 0.7% impact on the GDP growth. So we are looking for 2013 at a GDP growth between 1.2% to 1.5% in Japan. However, to end 20 years of deflationary expectation is not an easy task. And that we still need to see a rebound in the exports from Japan. The market, the consensus is very optimistic on Japan in terms of earnings delivery. We are looking at 30% growth in earnings for 2013, which is quite aggressive because the earnings growth expected for Asia ex-Japan is in the region of 13 to 14%. Of course, the Japanese market has moved up quite sharply over the last few weeks, but also the valuation of Japanese markets have moved up quite sharply. We are now looking at a market which is valued at 14 times PE against 12 times back in November. So if we want to see the Japanese market to move further, we need three elements. First, the company needs to deliver on the earnings growth. Second element, we need to see an end to those deflationary expectations. And third element, but it's going to be very tricky to achieve, we need to see a change in the behavior of the Japanese corporates in terms of returning value to shareholders.
And looking at Asian equities, they were actually rallying recently, and this week they hit the highest level since August 2011. Now, what are you expecting to see in terms of Asian equities?
Yes, you're quite right, Doireann. We saw that 5 key drivers for Asian equities have started to fall in place since September. And that led to a sharp rally into Asian equities. Those 5 drivers are, first one, we saw a global macro momentum stabilizing and the Asian macro momentum improving. The second element was a very positive liquidity impact from the central banks. We started to see the balance sheet of central banks in Asia to expand again, which is a good correlation with the performance of Asian markets. We saw as well the earnings revision starting to improve. We had improved sentiments, investors being less risk averse and turning back to Asian equities. And we had, of course, very attractive valuation back in September last year. So this led the markets higher. Short term, we would be very cautious. Because if we look at the earnings season so far, it has been quite disappointing in Asia ex-Japan. More than 50% of the companies in Asia ex-Japan who have reported have been below expectations, both in sales and net income. Second point, valuation has moved up. So Asia is not that cheap anymore. And third element for us is when we look at the market sentiment, it looks very complacent from our point of view. If we do a simple chart looking at the ratio of MSCI, SCI Japan divided by the volatility, this ratio is extremely high. We are 2 standard deviations above the longer term, which means that at this level, you are not rewarded for taking risk. So we wouldn't add risk into Japan equities, into Asia ex-Japan equity at this point. We would even take profit. But looking for 2013, looking at the second semester, we are very positive on Asian ex-Japan market because we believe into a rebound in the global manufacturing cycle and a rebound in the US economy in the second part of the year.
Thank you very much, Laurent.
You're welcome, Doireann.
Well, viewers, I hope you enjoyed this interview. That is it for right now, but do stay tuned to Dukascopy TV for more interviews and press reviews. But for now, goodbye.